Trading is 80% psychology and 20% strategy. I'm Kelly-Simmons, and today we're going to discuss trading psychology, some of the factors that can affect it, and how we can improve our trading psychology. I think the first thing you need with regards to trading psychology is a trading plan. Trading plan is so important to your trading game. It's a defined step-by-step process that's based on your strategy, and it's going to give you basically everything you need to surround your trade with. It's going to tell you when to get into a trade, when to get out, what to do in a what-if scenario. You know what I mean? What if your trade gets like 2 pips away from a take profit and then reverses all the way back to your entry point? Then what would you do? Are you going to wait and see what happens and run the risk of it possibly going to stop loss? Are you going to cut out at a break even? Your trading plan is going to be structured in such a way it's going to tell you what to do in that scenario. So all you really need to do is follow it. It may not be a psychological thing, but once you have a good trading plan and you stick to it, it helps build your confidence, right? It's going to help build up your confidence, and I don't think psychology is really going to be that big of an issue if you just have your plan and you stick to it. There are the issues with regards to trading psychology, and we'll get back to trading plan somewhat, but one of them has to be your emotional resilience. I mean, your worst enemy in trading can also be your greatest ally, and that's your mind, right? Don't be greedy, right? There's a lot of money on this market, and you're going to get some of it, but you can't be greedy. Rome wasn't built in a day. You're not going to become a millionaire overnight. This is not a get rich quick scheme. Well, a lot of people think it is, but it isn't. We have to stop taking shortcuts and realize that we have to put in the work. We're not going to get to where we want to go by skipping steps. We have to take each step. Sometimes we're going to have to take each step twice. And that's just how it is. And greed is an emotional thing because it's money we're dealing with. And a lot of people, everybody, is somewhat emotional to one degree or another about money. So once you're dealing with money, that greed factor is going to come in at some point or the other. You're only human, right? And what we're going to do is we're going to try to iron that out. So don't be greedy. Don't be emotional, right? I mean, a lot of traders who emotionally think that the market is against them, so the lack of execution as a result of being fearful that, the market doesn't like me. It's always against me. Every time I go to do this happens. Every time I go to do that, this happens. Excuse me. The market doesn't care about you. It doesn't care about you enough to be against you, right? I mean, you're going to have the trade that's well in profits and it goes back to break even. You say, what, the market doesn't like you? It doesn't care. What about the trade that you're winning? Right? Think about this scenario. You win a trade. You set up your trade, and your trade has a take profit of 30 pips. You follow your trading plan perfectly. You get the perfect entry. Your trade hits take profit perfectly. You win your trade, and you're happy about that. You come back and you look at the chart 2 hours later, only to discover that this trade went an extra 100 pips further in the direction that you went in. So now you're kicking yourself that you didn't stay in this trade longer. I mean, you need to be humble. Humility is also really important in trading. You're not going to get every pip that's available in the market, and that ties back into greed. You had your trading plan, you worked with your plan, you executed it to perfection, and you won your trade. That should be good enough. That should be more than good enough. The extra 100 pips that it went is not your business. If this somehow bothers you and it's a problem, then what I usually do is, after I win a trade, then just don't look at the chart for a while. Don't look at it for a few days. If I want to trade and I don't look at the chart for a few days, and a few days later I come back and I look at that particular currency pair, and I look at the chart and I realize that, hey, this thing just went 100 pips further than where I actually went. It doesn't bother me that much because it's 2 days later, right? But the bottom line is, you want to trade. You should be. I don't want to say happy because we're going to touch on being happy later on, but you should be contented that you won the trade. Bottom line, winning the trade should be the end goal, and you accomplish that goal, so you have nothing to worry about. Also your ability to pay attention to detail. Look, the best traders in the world, they see the charts, they see their strategy, and they either look at different info or they look at the same info differently. And they're always looking for ways to improve. If you're always working on your craft, looking for ways to improve, then your psychology is not going to be as shaky because you have a more solid foundation on which to build, right? So I think spending time learning your craft, owning your skill is also really, really important to psychology. The market can sometimes be a very unforgiving place, but the world have a way of balancing out itself. You stick with it, you work hard, and you put in the time and you put in the effort, you'll see the results, right? Psychology or not, you're going to see the results. I'm going to touch on gambler's fallacy, which is another aspect of trading psychology that's really, really, look, trading is not gambling, and thus it should not be treated as such. Just because you lost your last 10 trades doesn't mean that the chances of you winning the next trade is any higher, right? Some people might say, well, I just lost 10 trades, so I'm due for a win. You're not due for nothing. You didn't due for anything, right? You could lose the next 10 just as much as you lost the 10 before, or you could lose the next 50, or you could win them all, right? But trades need to be taken on an individual and singular basis. Each trade has to stand on its own 2 feet, right? The trade that you just took yesterday has nothing to do with the trade that you're taking today. Absolutely nothing. It might be the same currency pair, it might be the same time frame, you might be using the same lot size, but you're only one person in an $8 trillion market daily. You're not that important, I'm sorry to say. The market is not looking at what you're doing and moving based on what you're doing, right? That's just how it is, right? So just because you've lost 10 trades in a row doesn't mean that you're due for a win, right? Your next trade is just as likely to be a loss, as it is to be a win. It would depend on your strategy. It would depend on your ability to analyze the market, and it's also going to depend on how you place a trade and what happens externally, what happens with news, what happens with the charts. There are a lot of different factors that affect trading, and you losing 10 in a row is not one of them, right? So gambler's fallacy is not right. If you're having a problem with gambling fallacy, what I would say is you probably should take less trades, right? You should probably take a few. You should probably work on your strategy to the point where you're taking a few. You're probably trading too much, right? If you're trading to the point where you believe that the result of your next trade is somehow impacted by the trades that you took before, then you're probably taking a bit too many trades, right? What we're going to touch on now is revenge trading. Oh God, I call revenge trading the devil's work. If you want to lose money, if you want to blow your account, then go ahead, revenge trade. Be my guest. You know, trying to make back money that was already lost is like you going back yesterday to do something that you didn't do, or not do something that you were supposed to do, or something of the sort. It's gone. It's dead. You're not getting it back. Right? Look forward. Right? This ties into trading with emotion. Because again, as I said before, where we have an emotional attachment to money. We all love money. So that sight of that money going can sometimes be hurtful to a lot of people, and it can be more difficult to bear for some than it is for others. If you're having a problem with that, then I think you probably need to be taking smaller lot sizes, right? That way, when you lose, you don't lose as much money. The flip side to that is when you win, you won't win as much money, but your lot size should be in proportion to your account in any case, and that all leads back to your trading plan because that's going to be on your plan, right? So again, it touches back to working with your trading plan. Ideally, the trader that can lose a trade and just walk away from it like it's nothing is going to be a much more profitable trader in the long run than most other traders, right? Um, Revenge trading has to do also with, I think, people looking for instant gratification, right? And I'll tell you what I mean. You get in a trade now and you lost $50. So you're a bit salty over that. Okay, fine, you lost $50, it happens. So you're pressuring yourself and you're pressuring the market that you have to get this $50 back now. You don't have to get it back now. You could get it back tomorrow. You could get it back whenever the next best scenario presents itself. You don't have to create that scenario. That scenario is going to come to you, right? I think one of the things that causes revenge trading also is a lot of people set themselves targets. They might set themselves a target of, I want to grow my account by 5% every day, or 10% a day, or 30% a week, or I want to double my account every so and so days or weeks, as the case might be. That can have, especially if you set your targets somewhat unrealistic, that can have a really, really negative effect on your trading. Because you're looking for 5% a day. You might barely be getting it. So let's say you get it for 10 trading days in a row. You're getting like 6% here, 5% here, 7% here, and you're within that range. And today, you didn't even win 5%, but you actually lost 5%. So now you're 10% back from where you're supposed to be, and the trading day has ended. Tomorrow, you're going to try to get the 5% for tomorrow and the 10% you lost the day before. And that can have a snowball effect, because when you don't get that, you're going to find yourself 3-4 days down the road trying to make up 20% in one day. You're going to raise your lot size to try to make that money quick. You raise that lot size and that trade goes in the wrong direction, you're going to find yourself losing a lot of money fast, right? Because you just put unnecessary pressure on yourself to set a target. Where are you in a hurry to go? Right? Most of us who are trading are relatively young people, right? I don't know any 80-year-old or 90-year-old traders. They probably have a few, but I don't know them, right? So where are you in a hurry to go? We're going to have losing days. That's how it is. This is trading, right? If you're not prepared for that, then probably you're in the wrong business. Don't put unnecessary pressure on yourself to get a particular percentage. You could set targets, I'm not saying no, but try and set, I don't want to say modest, but try and set targets that would put as little pressure on yourself as possible. Right? That's what you ought to be doing. certain targets that would put as little pressure. You see, you're not looking for pressure, right? There are already enough pressure elements on the market as it is. You don't want to be your own pressure element, right? So, you know, pressure from targets, stop looking for instant gratification, pull yourself away from the market sometimes. Yeah, you know, you could lose a trade and just walk away. Just walk away. And then there's no rule that says you have to get 5% or 10% every day. You don't have to trade every day. You could be trading for the last 6 months and then you could just decide this week, hey, I'm good. I'm taking a breather. The same way on your job, you would take a vacation. You could take a week off from trading if you so choose, right? You need to treat this like a business. It is a business by all intent and purposes. By all intent and purposes, it is a business. So treat it like that. When you're running a business, sometimes you take a vacation. When you're working, sometimes you take a vacation. So treat it like that. Our next issue with regards to trading psychology is what we call FOMO. FOMO, the fear of missing out. Right? It's not the end of the world if you miss a trade. The market has lots of trades. There are always going to be trades on the market. So the world is not going to come to an end if you miss one of them. Right? And if you're scared or it frustrates you that you miss trades, right? Then you have a lot of work to do. Because here what happens with some traders. A lot of traders might miss a trade. Or worse yet, they might see this trade that based on their trading plan or based on their strategy. Well, if you're suffering with FOMO, then that means your trading plan just went out the window, right? So, you based on your strategy, you see this trade, and this trade is already well past your entry point, and it's going into the direction that you wanted it to go. But you were probably asleep, or you were probably working, or you're probably driving, or whatever, and you didn't see this information, right? So you decide to get in anyways. But you're getting into this trade late. Your trade setup was saying we're going for 50 pips. You see this trade when it's already 35 pips into the business. So you say, all right, I'm going to come in and get that last 15 pips. But what I'm going to do is I'm going to raise my lot size so that I can make the same amount of money that I would have made had I gone on to get into the trade early enough. You do that, that's a horrible idea. That trade starts going against you, and you're going to start losing a lot of money very, very fast. Listen to me, your lot size is something you don't play with, right? Your lot size has to be proportional to your account. Every trading plan should have that somewhere embedded in it. Your lot size has to be proportional to your account size. It has to be proportional to the risk that you're taking. If you're taking 1% risk on a trade, 2% risk, 3% risk, as the case might be, your lot size has to match up with that. So if you're really concerned about the fear of missing out, I use an app called Core Levels. You know, it's an app that notifies me when price reaches a particular. What do? You plug your information into the app beforehand, and when price reaches what would be an entry point or a point that you would like to see, the app notifies you. But with or without this app, you're still gonna miss trades, and you're just gonna have to accept that. That's something you're just gonna have to accept, right? You can't be on the market 24/7, 365 and view all how many of our currency pairs at all the time. So you're gonna miss trades, right? So that was a bit of trading psychology for us. As I said before, stick to your plan. Your plan to me is the biggest thing. Stick to your trading plan. Don't be greedy. Don't get too emotional. Pay attention to detail. and look to always improve. Right? You do those things, you're gonna find yourself getting more comfortable. And then things like FOMO, revenge trading, gamblers fallacy, and stuff like that aren't gonna find themselves into your trading life. Right? So until my next audio, I want everybody to take care of themselves and trade good. Take care.